Hello and welcome to the Friday Market Update. Well, steady as she goes, as they say. Hope you had a wonderful Thanksgiving, and I am truly grateful for the support you continue to give me. I absolutely love what I do, and I'm thankful for the chance to serve you and give you some value to bring to your clients. So, talking about rates, mortgage rates are sneaking down again without a lot of attention. The 30-year conventional rate is at 6.22%, according to Mortgage News Daily, my favorite website on the internet. We are inching back little by little towards the lows that we saw in September of this year and October of this year, which marked a 3-year low. The government shutdown is now behind us, and the gold standard reports the Fed relies on are finally starting to come out, but not fast enough. Most non-government reports have been pointing to a softer job market and inflation that is holding steady instead of heating up. So that's a good thing. It is not at the level that the Fed wants, but it is also not showing signs of breaking out and going crazy on us again. So because of the limited economic data during the shutdown, everyone expected the Fed to just hold the Fed funds rate steady at the December 9th, 10th meeting that is coming up. Several Fed governors said that they did not have enough data to justify a move. And now that more information is starting to trickle in, a December rate cut is actually back on the table. That could be good. Crossing our fingers for that. One of the more influential Fed governors has been very vocal about using the data we already have, the data that is non-governmental, but shows a lot of the things that we look at, jobs and inflation. In his view, there is plenty of evidence to support a rate cut to the Fed funds rate. Now, we are also getting close to having a new Fed chair next May. Every day, we get closer and closer to Fed Chairman Jerome Powell resigning, or not resigning, but ending his term. Now, the Trump administration is expected to announce the new Fed chair pretty soon to replace Jerome Powell when his term expires. And it is absolutely no secret that Trump wants lower rates to help the overall economy and housing market. You can see it in recent talk of his 50-year mortgage proposal and portable mortgages. And those are things that really show us that he wants to try and get that mortgage payment a little bit more affordable. The easiest way to do that is lower interest rates. So I think he's going to really make that clear that the next Fed chair will have more of a dovish rate policy, which lines up with the administration goals. Dovish means that they want lower interest rates. Hawkish means they go higher. Now, how do lower interest rates help the economy? So I want to break down something simple. Now, when rates come down, consumers feel it first, and the entire economy benefits. Lower rates mean lower monthly payments. It's simple as that. That puts actual dollars back in people's pockets. So when car loans, credit card interest, or a future mortgage payment drops even a little bit, budgets loosen up. So that extra cash flow strengthens the economy quickly. So lower rates also help more people qualify for a home. A small drop, as I know, and you should know, can lower the debt to income ratio enough to turn a not yet into yes, let's go for it. So more qualified buyers create more activity and more confidence in the market. There's also a psychological lift for homeowners. When rates fall and demand rises, home values almost always go up. That creates stability and encourages homeowners to spend on improvements, furniture, travel, and everyday purchases, which supports local businesses. Refinancing also becomes a great tool again. Many homeowners use a refinance to lower their mortgage payment or consolidate higher interest rate debt into one manageable payment. So that frees up money and improves household finances. We've seen some where they're saving $500+ a month. That's a lot of money that is given back to them that they can use for whatever thing they want. At the core of all of this is confidence. When rates move down, people just feel better about the future. That optimism fuels spending, businesses see more demand, and that leads to more jobs, better wages, and stronger economic activity. So when rates start to fall, consumers feel it first, and the ripple spreads through the whole economy. So if you want to know how this might affect your buying or refinance plans, reach out and I will run the numbers with you for your clients. So keep educating your clients on rates, what's going on with them. Lower rates push real estate values up over time. Buyers have a window right now. I don't quite know how long it is, but I'm guessing from now to maybe a little bit after the Super Bowl for buyers to take advantage of a very buyer-friendly market where sellers are providing concessions, buy downs, and whatnot. So that window will close as rates continue to drop. So hope you get an extended holiday weekend and a little more fun in there. I thank you very much again for allowing me to serve you, providing some value. This is Gaylord out. We'll see you next week. Bye-bye.